particular question, we are being told that BB Limited sells two types of products, branded D and A. The financial controller has prepared the following information based on the sales forecast for the period. So we have sales volume, we have unit selling price, we have unit variable cost, unit contribution, we have total sales revenue, and then we have total variable cost there. Then we get to, again, additional information given down there. We have now contribution to direct and common fixed costs. We have less direct avoidable fixed costs for us to be able to get operating profit. And then we deduct less common indirect fixed costs for us to be able to get operating profit. So what are they telling us there? The common fixed cost relates to the cost of common facilities and can only be avoided if neither of the products is sold. The managing director is concerned that the sales may be less than forecast and has requested information relating to the break-even point for the period required. The break-even point of the two products in units and sales value if they are sold in the sales mix ratio of, that is original sales mix ratio, and then 2 when they are sold in the mix of ratio of 1 to 1. So if you get a question of that kind, remember what I said. Under this topic, of course, you get back to intermediate topic number 2, where we do the classification of cost. And of course, we are going to classify cost here based on variability, whereby the only type of cost we need to understand here is 2 of them. That is variable costs, and then we deal with the fixed costs. So your work is to basically bring all the variable costs together and then bring all the fixed costs together. Because for you to be able to get the break-even point, now that we are dealing with multiple products, we need to take total fixed costs. Then we divide that by the weighted average contribution margin. What did you say about weighted average contribution margin? Weighted average contribution margin should be equivalent to summation of alpha, which is sales mix ratio, multiplied by contribution margin of each product. So that's what we are going to do for the denominator here. So the question is, are we able to identify the total fixed cost? Are we able to identify the total variable cost per unit? And then from that point, we'll be able to get what is required. So that is what we did yesterday. That's the formula we are going to apply. And of course, this one here is the break-even point in units. And don't forget, that's the formula of multiple products. Now that we are dealing with 2 products, then basically this is the formula we are going to apply. So once you get the break-even point in units, then what are we going to do? We are going to use the sales mix ratio for us to be able to distribute the break-even point in units for each single product. How do we get now the break-even point in shillings for multiple products? How do we get the break-even point in shillings for multiple products? It's basically the share here by use of the sales mix ratio. You get the share of each individual product, and of course, you take the units multiplied by the selling price per unit. Once that is done, you will be able to arrive at what we call the break-even point in shillings for each product or for the entire company dealing with those multiple products. So if you look at our question there, are we able to identify the 2 classifications of costs? Are we able to identify the 2 classifications of costs? So let's see if you're able to do that. Let's see if you're able to do that. So you're going to have the fixed cost here. And and then we'll be able to have the variable costs. So let's see. So within the question, we are given the first thing that we have unit selling price. So that one will not change. Unit variable cost, we have 300. So the unit variable cost given there is for product D. For product A, we are given 150. We are given 150 for D. We are given 110 for A. Do we have any other variable cost? Do we have any other variable cost? Do we have any other variable cost? We don't have. We don't have any. We don't have any, because you're able to see. So somebody's wondering, where are we getting the 360,000 from? Where are we getting 180,000 from? Yet we only have 150 given up there. Remember, the volume of these products here, we are given a volume to be 1,200. So that is now the units, 1,200, which we should be able to write the word expected. Expected units. So we have 1,200 for A, and then we have 600 for B. So once you have your variable costs, can you try to take 1,200 to multiply by 150? You should be able to arrive at a figure that will be giving you the total variable cost. So if you do this, what will you have for A? What will you have for A? For B, that is for D. For A, you'll be able to see, you're going to take now 600, you multiply by 110 for you to be able to get the total variable cost of product A. Are you able to get the figures? What do you have for this one here? What do you have for this one here? I'm told this one is 66,000. How about this? For D, we should be having a figure of 1,200, that is 180,000. So if you look at the question there, the statement given, you're able to see where we are getting the total variable cost from, that is 180,000. You're able to see where you're getting 66,000 from. The total revenue given there, remember your revenue is equivalent to the units that are going to be sold, the expected units, multiplied by the selling price per unit. So for example, for D, we have selling price as 300 shillings per unit. So if you take 300 multiplied by 1,200, you are getting 360,000. And the 360,000 is basically what we take and deduct the variable cost for us to be able to get the total contribution, the gross contribution of that particular product. So if you look at the totals column, we have 480,000. If you deduct 246, you are having 234,000. That's what we have as the contribution to direct and common fixed costs. Below that, we have direct avoidable fixed costs. So these fixed costs can be avoided, as you can see, they can be avoided. And then we have operating profit, and then we have another expense there, common indirect fixed cost, which is making these people to get the total operating profit. So there is no any other variable cost that was omitted. This is the only variable cost. Remember, we are dealing with two different products, and therefore we have to look at the total cost in totality. Therefore, let's now come to the column of fixed costs. Are we able to identify the fixed costs here? So the first section, or the first part where we are meeting the fixed cost, is direct avoidable fixed costs. So direct avoidable fixed costs. Direct avoidable fixed costs, we have 90,000 plus 27. That is giving us 117,000. How about any other fixed costs that you're able to see there? Any other fixed cost? We have common indirect fixed costs. Common indirect fixed costs of what figure? Of 39,000. So it does not relate directly to any product, but should you decide to do production, then automatically you are going to see that will be a fixed cost incurred by this particular company. For example, let's say this fixed cost here, the direct avoidable fixed cost here relates to depreciation of machinery. Is it depreciation of machinery? We have insurance expense of machinery, is it? So these two, whether you stop production or not, I mean, if you stop production, you stop about the business, then automatically you are not going to incur anything to do with the depreciation of machinery. You are not going to pay anything to do with the insurance expense of this particular machinery. How about you have now administrative block, where this building has been leased and the company is paying what we call lease. The company is paying what we call lease rentals. Is it? This lease rental here is basically for the building that is hosting the offices of the company. So whether you do production or not, maybe the company can shift another thing, and therefore they still have to pay the lease rentals. Is it? They have to pay the lease rentals. It does not directly relate to any particular product that the company is producing. But at the end of the day, it is forming part of the fixed cost that the company is actually paying for. And therefore, how do we now get the total fixed cost? It is the direct avoidable fixed cost plus the common indirect fixed cost. So if you add all that, what will we have as our total fixed cost? What will we have as our total fixed cost? So total fixed cost will be equivalent to 117,000 plus 39,000. What are you getting? 156,000. 156,000. So that's the total fixed cost which we are required to actually have there. So it means once you have the total fixed cost, we have the variable cost, we have the selling price per unit, we can basically go ahead and get our break-even point. We can go ahead and calculate our break-even point for the multiple products. So we are going to have product D. We are going to have product A. Then we have selling price, which is 300, which is 200. Then we have variable cost. We have variable cost given there as 150. And then we have 110. Our contribution, so contribution margin, of course, you less. For you to be able to get contribution margin 150, and then we have 90. Good. So we are lacking something here for us to be able to get the weighted average contribution margin. What is it? We are basically lacking here a sales mix ratio, which we are calling alpha. So the sales mix ratio here basically relates to the proportion of each particular product within the mix. That is, product D, the company is proposing or is supposed to sell 1,200. For product A, the company has projected sale of 600 units. Total number of units that we are going to sell here, total number of units, if you come to the total column, what are we having? 1,200 plus 600 is giving us 1,800, is it? 1,800. So, of the total, D is having 1,200. Of the total, A is having 600. So what is the proportion? of the total that each product will be taking. What is the proportion here? What is the proportion here? Yes, at least 4 decimal places. 0.0667. How about this other one? The difference between that and 1? 0.0333. So that is the sales mix ratio that you're talking about here. Okay, alpha 0.667, 0.3333. Good. Once you have your sales mix ratio, then you should be able to give us now the average contribution margin. So average or alpha multiplied by contribution margin, alpha multiplied by contribution margin. So when you take alpha, you multiply by contribution margin. What are you getting here? The first one, 150 by this. 150 by this should give us a figure. So we are getting 100. If you did not round off, I think you should be getting a whole figure, which is 100, right? Good. How about this other side? If you take 0.33 by 90, what will you have? We'll be having 30 without those decimals, I think so. We'll be having 30. So that's 100. And so can you now go ahead and give us, remember we are required to get the summation of alpha multiplied by contribution margin, which will now give us what we call weighted average contribution margin. So go ahead and give us that. The summation of 100 plus 30 is equal to 130. So that is our weighted average contribution margin. The total fixed costs, we already have them. The total fixed costs, we already have them somewhere here, which was 156,000. So our break-even point in units will be equivalent to total fixed cost, which is a total fixed cost over weighted average contribution margin. So total fixed cost, we had 156,000, and we divide by weighted average contribution margin, which is 130. So if that is done, what is our break-even point in units? What is our break-even point in units? 1,200. 1,200. So you want to now distribute this 1,200 to the individual products. So what number from this 1,200 will we give to D? What number from the 1,200 will we give to D? D will have the sales mix ratio, that is 0.6667. D will be taking that, and of course A will be taking 0.3333 multiplied by the same amount. So what are we going to have here? What are we going to have there as the share? So I'm told D will be having 800 and A will be having 400. Good. Go ahead and give us now the break-even point. Break-even point in shillings, is it? The break-even point in shillings, D will be having 800 units. We multiply by the selling price per unit of D, which is 300. And then A, you will take 400 units of A multiplied by the selling price per unit, which is 200. So what do we have? What do we have for D? So D will be giving us 240,000. 240,000. How about A? How about A? How about A? A will be giving us what figure? Why multiply the sales mix ratio and break-even point? Good. Why are we multiplying the sales mix ratio by the break-even point. Why are we multiplying that? Can someone assist? Can someone assist our friend there? Why are we multiplying the two? Why are we multiplying the two? Remember the break-even point in shillings of a single product. We said the break-even point in shillings of a single product, we said is equal to total fixed cost divided by contribution margin ratio. This contribution margin ratio, we said contribution margin ratio is equivalent to contribution margin divided by selling price per unit. Is it? That's what we said is the contribution margin ratio. Now, look at the contribution margin here, which we are getting. So my question is, are you going to take the contribution margin of product D, which is 150, or of product A, which is 90? Are you able to see that? We cannot take one. We cannot take the two of them. Is it? We cannot get the summation of the two. But what are we going to do? That's why you're going to look at, of this contribution margin, what is the proportion? You can get that this one here is only having 100 products. This one here is having even 500 products. But then if you look at the contribution, it's again very low. So the question is, are we able? That's why we are going ahead and getting the average. The average of this contribution, we are taking contribution multiplied by the proportion of the total sales, multiplied by the proportions of the projected sales, which you're able to see was giving us 0.667, such that if you look at the sales mix ratio, if you add this one here, you should be able to get 1. Is it? You should be able to get 1. Now, once you have been able to calculate the break-even point as 1200, what are we going to use to proportion? To do what? To proportion the 1200 units to product D and A. You cannot assume and say, because D is having 300 shillings per unit, we are now going to give it the highest number of units. No. So which basis are we going to use to distribute the 1200 to these two different products? Because this 1200 here entails units of D and units of A. Not just a single product. There are multiple products, and therefore, that's why the sales mix ratio is helping us to distribute this. So once you've been able to distribute, that is the proportion of the total, which is 0.667 by 1200, is giving us 800 units of A. Another thing, why is it now that we are not going to use this formula? The reason why you're not going to use this formula for multiple products, look at what we have here, the selling price. For product D, we have 300. For product A, we have 200. So we cannot say that because our break-even point in units is 1200, so we take 1200 and then multiply by 300. Is it? If you multiply by 300, remember, you've even included the units of D, which should be sold at 200. All of them have been included here. Whatever you're going to get here is wrong. Is it? If you decide again to say that all the 1200 units we multiply by the selling price of A, which is 200, you will be lying to us because you've included the units of D, which should be sold at what price? At 300. So again, what you're going to have there is wrong. But if you use the proportion, here, you will be able to get the actual units of A, the actual units of B. And of course, you take now the actual units, multiply by the respective selling prices for the products. That's why we've taken 800 for D, we multiply by the selling price of D. We've taken 400 for A, we multiply by the selling price of A. Once that is done, you now go ahead and get the summation, and that becomes the break-even point in shillings for the entire company. So is that clear now? Is it now clear to somebody? Is it now making sense to somebody? Is it now making sense to somebody? Good. So I believe your question is answered. Now, Somebody want to prove whether what you are having here is correct. Are you able to prove and confirm that at this particular point of operation, you are not going to make any loss, you are not going to make any profit? Yes, we can prove that. So let's just come here. Let's just come here, then we prove that together. So once you have the contribution margin, you can go ahead and give us now the units. So yeah, basically, we want to prove whether what you're having here is correct. So the units, the actual units for D will be 800. The actual units for A will be 400. So why can't you go ahead and give me total contribution? So total contribution, we have 150 by 800. What are you getting? 150 by 800. 150 by 800. What are you getting? $120,000, is it? How about A? 90 by 400, 36,000. Not forgetting our fixed cost, so don't forget it. So if you now come here and give us total contribution, total contribution, you take this plus this, we are having 156,000, is it? Then you less fixed costs. So the fixed cost given here, we have 156,000. Go ahead and give us the difference. What is your net profit? Stroke loss. Net profit stroke loss. We're having a figure of 0. What is this concept of break-even point? The concept of break-even point is that it is the quantity or the total revenue we are supposed to receive for us not to make any loss, for us not to make any profit. At this point, when we sell 800 units of D and also sell 400 units of A, we are going to have a total revenue of 320,000. Then we less the variable cost, then we less the fixed cost for us to be able to get net profit. And at the end of it, our net profit is 0. Our net profit is 0. I believe you understand. When I talk about contribution here, I've basically taken the variable components. The selling price per unit here depends on the units of output. The variable cost here depends on the units of output, is it? So that's why we are dealing with the variable component, the variable items, that is selling price, which depends on the units of output or activity level. So once you get the net amount, then this one here, multiply by the units of output, because selling price and variable costs depend on the units of output for us to be able to arrive at total revenue. Or someone can also decide and say, you can decide and say, let me not follow that of then summarizing. So you come here and give us revenue. So revenue of the two products is 240 plus 80, which is 320. Less costs, is it? So the cost here we have variable costs. How do we get that all variable cost? It is 150. We multiply by 800 plus 110. We multiply by 400. If this is worked out, what are you getting? So that I get my contribution. Then I less. Or I don't even bring in the contribution thing. I just come and less fixed costs. So I'm told this one here will give me 164,000. And of course, fixed costs, we add 156,000. So if you deduct these costs, so less costs, what will you have as your net profit? 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 When you get the difference between the total revenue and the total cost, we are getting to 0. So it is basically the same thing here. is basically the same thing that we are having here. So that's what you are required to do in Roman 1 of the question. Use the sales mix ratio for you to be able to give us the break-even point. Is it? The break-even point. And once you get the break-even point in units, you now go ahead and give us the break-even point in shillings, which you'll be able to see is 320,000. That is Roman 1, using the original sales mix ratio. Now, they are telling us that they want to interfere with the sales mix ratio. They want to interfere with the sales mix ratio. And I want you to get this. I want you to get this. Someone will be confusing this, but it is very, very important to us. So we are now tackling Roman 2. I expect you to start that Roman 2 by putting this down. I want us to start Roman 2 by putting the all of this part, by writing the all of that down there. So what we are lacking here for us to get is the alpha or sales mix ratio. So don't write this. Don't write the one I want to get here first. 0.6667, 0.3333. Good. This is the one that we are able to calculate in Roman 1. So the only thing that we are changing in the question is the sales mix ratio. What are they telling us? The sales mix ratio has been changed. Is it? It has been changed to be the ratio of 1 to 1. So look at this. This is what we are having. This is the sales mix ratio that we are having. So we have 1, ratio of 1 to 1. Let's say this is D, or let me bring in a different one. I have ratio of 3 is to 4, and I have product K, L. Are you able to give me the proportion that K will be having? So you first of all add all these figures. You first of all add these figures. You are going to get 3 plus 4 will be giving you 7. Is it? So 3, K will be 3 over total. L will be 4 over the total. That's what we are having here. So this is going to be the ratio. I mean the sales mix ratio that we are having here. This one and this one here. Is it? That's what we are having. So if they tell you that it's going to be in the ratio of 1 to 1, I know somebody here will be coming and telling me 1 and 1. Someone will be coming here and saying, now the new sales mix ratio will be 1, 1. No. If they give that the ratio is 3 to 4, then now the proportion, the fraction of that, K will be having 3 over 7, L will be having 4 over 7. Is that clear? Is that clear to somebody? Is that clear to somebody? Is it clear to somebody? 3 to 4 is not 3 and 4, but it is 3 over the total, which is 7, and it is 4 over the total, which is 7. So having identified that, are you able to give me the new sales mix ratio of D and A? Given that they are telling us the ratio will be 1 is to 1. So go ahead and give me the new sales mix ratio here. So I'm told it is 0.5 for half, and then 0.5. How are you people getting 0.5? We have 1 and 1. So add the 2. We are going to have, so we have 1 over the total. We have 1 over the total. So this is what we are going to have. D will be having half, which is the same as 0.5. A will be having half, which is the same as 0.5. Is it? Yeah. So once that is done, please go ahead and give me now the sales mix ratio multiplied by contribution margin. When you take 0.5 by 150, what are you getting here? 0.5 by 150, what are you getting? We are having 70, 75. How about this other one? 0.5 by 90, we are having 45. So how about the summation that is now the weighted average contribution margin? Weighted average contribution margin, what are we having? That is now when we add the two. So if the two are added, what are we having? 120. Let us not forget our total fixed cost, which does not change. Our total fixed cost, which does not change, was equivalent to 156. I think so, if I'm not wrong. Good. So please go ahead and give me the break-even point in units. The break-even point in units will be total fixed cost divided by weighted average contribution margin. That is 156,000. You divide by 120. Is it? If that is done, what are we having here? 1300 units. That is the break-even point in units. Please go ahead and give me the proportion that D will be having of this 1300 that A will be having of the 1300. Is the sales mix ratio multiplied by what's supposed to be shared. So each will be having 650 units. Let's go ahead and get the break-even point now in shillings. So the break-even point in shillings, we are going to have D having 650 units multiplied by the selling price per unit. You're going to have A having 650 multiplied by selling price per unit. Please go ahead and give me the amounts for D. So D, I'm told, is equivalent to 195,000. A will be equivalent to what figure? 130,000. So there are some key items that they're going to ask you. Remember, the original sales mix ratio was interfered with, whereby D was giving us 800 units, A was giving us 400 units. If that sales mix ratio was maintained, then we add to sell only 1,200 units for us to break even. If we interfere with this and produce the same number of units for a maximum of 1,300, we have to produce that 1,300 for us again to break even. Is it? So something is happening. Here we have to increase the units from 1,200 to 1,300 for us to break even. Now, what are some of the implications of increasing the quantity from 1,200 to 1,300? One, you look at the demand. If you produce all these products in the same quantity, is the demand of the two products the same? Is it? In the production of this particular product, of course, maybe the raw material is the same, that's what they're sharing. Now, another thing, is the company having the capacity to increase the units by additional 100? That's what you need to look at. Capacity in terms of resources and also then the storage space. Now, if we add all this, what are we getting? If you add all this, what is the least revenue that these people should be having for them not to make any loss? 325. So you're able to see if they're going to increase the units in the name of adding more profit, they are not going to. They have to bring in more revenue by 5,000 for them not to make any loss, not even to retain that, for them not to make any loss. So what is the need of increasing the units? Yet you'll still be forced to operate at break-even point by having a revenue of 325 instead of making it at 320, but still you are at the same point. So that's the revenue, which again we can confirm. You can confirm that. So revenue is 325,000, contribution margin is this, and our total fixed cost is 156,000. So you want to see if contribution margin will be equivalent to total fixed cost, then automatically we'll be able to know that the company is operating at break-even points where there is no loss, there is no profit. So contribution margin has not changed, but now we multiply that by the quantity. So we take 150,000, sorry, 150. We multiply by 650. we add 90, we multiply by 650, that is the quantity. The all of this will give us total contribution, then we less total fixed cost, which is 156,000. If that is done, you should be getting 0. If you don't get 0, please let me know. If you deal with this one here in this manner, you should be getting 0. Is that the case? Is that the case? Good. So Emmanuel is confirming that if this is worked out, you're basically getting to 0. And what does that mean? You don't have any loss, you don't have any profits. What are we referring to? The break-even point. So as per the question given there, you are required to give us break-even point in units and even distribute it if possible, because upon distributing it, you will be able to proceed with the other part, which is break-even point in shillings. So is that concept now clear to all of us? Is that concept now clear to all of us? Before we look at another one, is the concept now clear to all of us? Is the concept now clear to all of us? So we should be looking at question 2. Question 2A. But the question 2A given there is now talking about the limiting factor. The limiting factor and throughput accounting. So throughput accounting, the difference between throughput accounting and limiting factor is very, very simple, which of course we are going to do it again extensively under inventory management. Under inventory management, when you talk about throughput, and then we have limiting factor. So this variable cost, of course, they have been combined. Malim, can we have a short prayer break before we look at another question? Yes, let me see the time. Okay, we can have a break. Let's come back at 7:04. Let's come back at 7:04. December 2022, question number 2A. And of course, this one here, we are going to cover this on, we'll be covering this concept here basically on Sunday. That's when you're going to do it into details. But now, limiting factor, of course, you did it at intermediate level. The difference here, the throughput account, remember when you are getting the contribution margin. The contribution margin, these are the costs that you're going to incur for you to be able to get a particular product, the cost per unit. So here, it only says that the only item that will be forming part of the product cost under throughput is direct material. Direct material. So all other factors that are going to be added there, they're basically regarded as overheads. They do not form part of product cost. It is only direct material. Under the limiting factor here, based on the question that you're going to see on Sunday, you'll be able to see that direct material, direct labor plus variable production overheads will be forming part of product cost. So we are going to use this for us to be able to get the limiting resource, is it? So these items that you're going to use in the production of, let's say item A, these ones form part of the product cost, and then now you get the non-production cost, the fixed cost that not do what? Do not relate directly to the product cost. So this is what we are going to do on Sunday. The limiting factor here, let's say you have been told that the company, based on the demand of this particular product, the company requires 25,000 labor hours. Is it? 25,000 labor hours for them to be able to produce product T or product D, K, L, M. So these are 4 products they're supposed to produce, and for them to meet the market demand, they need 25,000 labor hours. The company, based on its capacity, the company is only able to provide 13,000 labor hours. 13,000 labor hours. How will they come up with a strategy or a method for them to be able to apportion these 13 hours in a manner that will maximize their income? So that strategy, that formula which you are going to apply to tell them that you should be able to produce this number of units of B, this number of units of K, this number of units of M, or even drop M, but still at the end of the day, you'll be maximizing your revenue, then that's what we call about, or that's what we refer to as the limiting factor analysis. But of course, in the context of a question where they bring in limiting factor and throughput, we just know that direct material is the only variable cost that is forming part of product cost. Any other cost that will be incurred, be it direct labor, then automatically they do not form part of product cost. They are regarded as production overheads, or even just overhead cost, which do not form part of product cost. But these ones here, under limiting factor, direct labor must form part of product cost. Variable production overhead, the fixed production overhead will form part of product cost now, but it depends with the method that you are applying. Are you using marginal or absorption? Absorption costing is also called full costing, which I believe you're able to remember. Marginal, we also call it variable costing. The difference between these two again is basically based on the usage of what we call fixed production overhead. Under absorption, fixed production overhead forms part of product cost. Under marginal, fixed production overhead is regarded as non-production cost, and therefore it is expensed in the income statement as one of the operating expenses. Okay, I believe we've now been able to receive or to access the question for the December sitting. Is that the case? December sitting, remember, it is still touching on topic number 3, that is CVP analysis. But now look at the question. Imagine you've covered that in class, and then when you get to your example, question number 1A, you get a question similar to what we just want to do. Will you be able to confirm that you really covered CVP analysis in class? Will you be happy about the CVP concept? That is what we have there. So what you need to understand is, before you look at the CVP analysis, you'll be able to see what we have there. We are told to use CVP analysis criteria to simulate the problem and determine the average profit. So the main thing there is basically about simulation, but then it is referring to CVP analysis. So what you need to understand is, which I believe you did in your AFM, when you're going to deal with simulation, this is what you need to consider. I've been given selling price. Is it? So I have 300, I have 200, then I have 450. Here, the probability that I've been given here, I have 0.2, 0.6, 0.2. Then another one in another place here, I've been given selling price. That is 300 still, 200, 450. But now they are not giving me 0.2. They are giving me 0.02, 0.06, 0.02. What you need to understand here is, are you able to come up with the range? Because our interest here is to come up with the range. So come here and give us cumulative probability, which would be 0.2, 0.8, then 1.0. And then you come now and give us the range. That's what I want to discuss with you. Once that is done, you'll be able to understand it. So cumulative probability, we have 0.02, 0.08, and then 1.00. Then you come to the range. I believe you're able to see that. So for the range here, look at what we are having, and I want you to tell me the pattern. So here I'm going to start with 0 to 1, 2 to 7, 8 9. The same items actually, here I'm going to have 0, 0 to 0, 1, 0, 2 to 0, 7, 0, 8 to 0, 9. For example, let me just try to do that. Let me just try to put that there. So if you look at what I'm having, if you look at what I'm having here, if you look at what I'm having before you get to this other side, if you look at this, if you look at this, you'll be able to understand that the number of decimal places that I'm having here is basically 1, is it? So if the number of decimal places is 1, then that's what you deal with. That's what you deal with here. You have to maintain the number of decimal places. If I have 2 decimal places, then look at how I'm changing this. Look at how this is being changed. So of course, this is just something that has been brought because we are touching on CVP analysis and we are covering CVP analysis. That's why I had to bring it here. But if you go to topic where you're going to do inventory, then you're going to do this extensively. You'll be given the lead time, you'll be given the number of orders, and then of course, with the different decimal places for you to be able to come out with the range. In this particular question for the December sitting, they tested the same under simulation, but because they are touching on CVP, we have to do it as early as in this topic number 3. So look at what we have there. When dealing with the CVP analysis, they have mentioned CVP. So someone is still wondering, how is this question related to CVP? Was it an error? No, the error was not there. So let's look at December 2, question number 1. Is it number 1? Do you know number 1 be? Let's see. Question number 2A. So if you look at that question, remember how we are doing the CVP analysis. For us to get break-even point, we are getting total fixed cost divided by contribution margin. How are we getting contribution margin? Is equivalent to S minus V, is it? So they want us to have columns whereby we get S minus V for us to be able to get contribution margin. That's number 1. Number 2, we said that the changes in revenue is basically the result of changes in volume or quantity of output. And therefore, we need to have quantity somewhere here. Is it for us to be able to get now total net contribution? And now that you have total net contribution, fixed cost will be constant. Fixed cost will be constant throughout. So you have a column for the fixed cost all the way to the last one. And since you have now the 3 or the 2 of them, you should be able to arrive at what we call net profit. You approach it using the CVP analysis concept, but of course, at the end of the day, you'll be able to get net profit. The net profit here, we are given the random numbers to run from number 1 to 10. Is it? From number 1 to 10. So it means for the first one, you'll be getting net profit, the second one, the third one, all the way to the 10th item. So what do we do for us to get the average? It's the total profit you're going to have here, then you divide by the number of observations. If that is done, you'll be able to arrive at what we call average net profit. And that's what is required of you. So the first thing we need to do together, here, is basically looking at the range. So the first item, the items given to us, we have selling price. So I have selling price that I'm going to indicate somewhere here. Selling price. I believe you're able to see that. Yes, actually there's enough space. So we have selling. We have selling price, then we have probability, cumulative probability, then we get range. Is it? So we are going to have 400 for 5,500. 400 for 50, 500. Then we have just a minute. So we have sorry for that. So the probabilities here, we have 0.3, we have 0.5, we have 0.2. Is it? How about cumulative probability? So here is basically cumulative probability. So cumulative probability, we are going to have 0.3, we have 0.8, we have 1.0. Is it? How about the range? We start with 0 all the way to the number before this, which is 2. We start now from 3 to 7, and then we start from 8 to a number before that, which is 9. Is it? Once that is done, we now go to the next item, which is variable cost. Variable cost. Variable cost, we have 200. We have 250. We have 300. Is it? Then probability, we have 0.1. We have 0.6. We have 0.3. How about cumulative probability? Cumulative will be 0.1, 0.7, 1.0. So you can see the number of decimal places 1. And therefore, if you now come to the range, here, you will be able to give me, that is starting from 0. And of course, the number before this is 0. Then we come to 1 to 6, 7, 9. Is it? Then you move to the last one, which I'm able to see annual sales volume. So we have quantity or volume. So you can talk about volume. You'll be having probability, cumulative, probability, and of course we have range. So once that is done, we are going to have 40,000. We are going to have 50,000. And then we have 60,000. For that, probability is 0.4, 0.5, 0.1. So we have 0.4 the cumulative, 0.9, and then 1.0. So we have 0 to 3, we have 4 to 8, and then we have 9 to what figure? Somebody? It looks like the simulation worksheet in FM. Yes, the same thing actually. So what will you have here? Let me see. You must take a number before this, but now this one is there, the ending number. So we have this. So what will we have? What will we have here? Somebody 9 to 9, is it? 9 to 9. So that's what we need to take care of there. That's what we need to take care of. So this will be your reference point. Anytime you want to write down the selling price, then you have to go to this table and tell us which number you're going to pick, depending on the random numbers given there. So if you look at our table there, we are being told that Lengo Limited is considering marketing a new product. The fixed cost of this product will amount to 5 million. So we already have fixed cost somewhere here, which will be constant throughout. Then we are being told there are 3 uncertain factors, namely selling price, variable cost, and annual sales volume. So these things here, they are not sure. That's why we are given the probability. And therefore, The random numbers we are going to have will enable us to identify the specific item to pick. What is it? After variable. After variable cost, we have probability, cumulative probability, then range. Then this one here is volume. This one is volume. Or you can indicate the word quantity. It is basically what we have in the last column, annual sales volume, which are given in units. So can give us the quantity, whichever, but basically referring to the units. Then we are being told that the product has a life cycle of only 1 year, and the various possible levels of these factors together with estimated probabilities are given below. Additional information: assume that the 3 factors are statistically independent, so they don't depend on each other. And that's why we are given the different random numbers. The company uses CVP analysis to make a decision. The following random numbers are provided. Required: using CVP analysis criteria, simulate the problem and determine the average profits. Is it? So are we able to do that? You first of all come here and give us the random numbers here. So we have number 1 to 10. So we have random numbers for the selling price. Is it? So we have RN. And of course, we have selling price. Selling price. So the random numbers, we are going to have them again all the way to number 10. We get the selling price. That selling price you need to multiply by. So this selling price you need to multiply, or you need to deduct the variable cost here for you to be able to get contribution margin. So variable cost again is a changing item. So I need to come here and bring in the random numbers for the variable cost for me to be able to get the variable cost. Is it? For me to be able to get the variable cost. So once I have the variable cost, so this is variable costs. Once I have the variable cost, then I come here. I will come here and get contribution margin. This contribution margin, I need to subject it. I need to subject it to what we call the quantity for me to be able to get total contribution. So I need to come here and get quantity. Quantity, of course, is the volume. This volume here, or units, I'm also required to get the random numbers for me to be able to arrive at units or volume. Can talk of volume. So once we have that volume, we will be able to arrive at what we call total contribution. We'll be able to arrive at what we call total contribution. Total contribution margin. So once you have the total contribution margin, you will be able to take us now to total fixed costs. Total fixed costs, which will now lead us to the point of getting what we call net profit, which will lead us to the point of getting net profit. Good. So let's come to the first one. The first one here, for us to get the selling price, I want us to pick the random numbers. So the selling price, the first number is 8. Is it? So let's indicate the numbers. We have 8. We have 0. We have 6. We have 1. We have 3. We have 5. We have 1. We have 3. We have 9. We have 1. Good. So you come here and tell us where this random number is falling. What are we looking for? Selling price. Within this range, where will we get 8? Where will we get 8? In the last row, is it? corresponding to which number? 500. So the selling price here will be 500. I come to the second one, 0. Where does 0 fall? It is from 0 to 2. What is the corresponding selling price? 400. How about 6? Somebody tell me where 6? What I'm going to have under 6? If my random number is 6, what will be the selling price? If my random number is 6, so 6 will be within this range, which is 400 and 450. Is it? 1 within the first range, 400. 3 within the second range, 450. 5 within the second range, 450. 1 first range, 400. 3 second range, 450. 9 within the last range, which is 500. And of course, 1 taking us back to 400. That is what we have. That is what we have. Let me write down the random numbers for variable cost. So the random numbers for variable cost is starting from 0, 4, 3, 4, 6, 7, 2, 8, 5, 9. Good. So what do we have? The first one, under variable cost, we now come to this table of variable cost. Where do we get 0? 0 is falling within the first range. So what will be the variable cost? Our variable cost will be 200, is it? How about 4? How about 4? How about 4? Under variable cost for 4, is it the first range or the second range? It will be within the second range, and therefore it corresponds to 250. Then we get 3. Where do we get 3? 3 within the second range again, 250. 4 within the second range, 250. 6 within the second range, 250. 7 third range, 300. 2 second range, 250. 8 300. 5 250. 9 300. That is what we have, is it? So before we move to the volume, I want us to get contribution margin together. How do we get contribution margin? Contribution margin is equivalent to selling price per unit minus variable cost per unit. So what is the contribution margin for the first random number, the first row here? What is our contribution margin? That is 500 minus 1. So we have 300, is it? How about the second one? 400 minus 250, 150. The third one, 450 minus 200, 200. Is it? Minus 250 will be 200. 400 minus 250, the same thing, 150. 450 minus 250, I did have the same thing here, so it will be 200. 450 minus 300. 450 minus 300, that is 150, is it? 400 minus 250, that's 150. 450 minus 300, that is 150. 500 minus 250, that is 250. 400 minus 300, that is 100. Is it? That is 100. Good. Let's go to the random numbers for the volume or quantity. So the random numbers for volume or quantity will be 6, 3, 9, 4, 0, 9, 7, 6, 8, 5. Good. So let's look at the volume or quantity. So we now come to this part here and look for the volume. So the first one, we have 6. Where do we get 6? 6 is falling within this particular range. So our quantity will be 50,000, is it? 3, where does 3 fall? The first one, 40,000. Where does 9 fall? The last one, 60,000. Is it? Where do we get 4? Second one. Where do we get 0? The first part here. So that is 40,000. Where do we get 9? The last one here, 60,000. So I believe you are following that. I believe you are following that. The speed is okay. Here 4, we are going to have 7 within that range, 50,000. Then number 6, that is when we have 6 within this range, 50,000. 8, the same range. 5, the same range. 5, the same range. Good. So once that is done, we should be able now to get total contribution. So how can we get total contribution? We take contribution margin per unit multiplied by the unit or volume. So this one here, just know it is quantity. So contribution margin per unit multiplied by volume, what will we have? The first one, 300 by 50, 300 by 50, 15 million or 1.5. Somebody to confirm, somebody to confirm. What will we have there? 15 million, is it? So we have 15. We have 15 million here. That is the first one, 15 million. The second one, 250 by 40,000. What will we have? 250 by 40,000. 250 by 40,000. 250 by 40,000. What will we have? 250 by 40,000. What will we have? 10 million. Somebody's talking about 6. 250 by 40, 10 million. How about 250 by 60 million, by 60,000? Oh, it is 150. It is 150, not 250. Contribution margin, we are actually taking this times this contribution margin times volume quantity. This is what we are actually preparing. So 300 by this, 15. 150 by this should give us 6 million, is it? 6 million. Because 150 by 4 will be 6. 26 million. $600. Good. How about the other one? 200 by 60. Is it 1.2? Is it 1.2 or 12 million? 12 million. Good. This one here, 150 by 50. Is it 7.5? Then we have 200 by 40. Is it 8 million? Yes. We have 300 by 60. 300 by 60. Is it 18 million or 9? Hapa ni ngapi? Oh, 150. 159. $150 by 50. 50 by 50, I can see the same thing here. 150 by 50. 150 by 50, the same thing up here. 50 by 50, the same thing. 250 by 50. 250 by 50. What are we getting? 12,500,000. And the last one, 100 by 50,000. 100 by 50,000. 100 by 50,000. That is 5 million, is it? Good. So can someone go ahead to the question and tell me the fixed cost? What was the total fixed cost? Total fixed cost, what were we having? What was the total fixed cost? Total fixed cost. What were they telling us about the total fixed cost? That the fixed cost of this product will amount to 5 million. Is it? So come down here and write 5 million all the way to the last part. $5 million. $5 million. So are we done with that? Have you been able to do that so that we get to the last part? Are you done with the section of putting in the total fixed cost? Good. You have total contribution, you have total fixed cost. What else can stop you from getting the net profit? Nothing. So let's get the net profit here. So I'm having 10 million. Here I'm having 1 million. Yes. Here I'm having 7 million. Having 7 million. Here I'm having 2,500,000. Here we have 3 million. Here we have 4 million. Here we have 2.5. Here we have 2.5. Here we have 7,500,000. Is it? If there's anything wrong, please let me know. 5 million minus 5 million, that is 0. That is 0. That is 0. Good. Total 40 million. So I'm told if you add everything here, you're going to have 40 million. If you add everything here, you're going to have 40 million. If you add everything, you are going to have 40 million. Please confirm. Is that the case? If you try to add everything, is that the case? Will you be able to get that 40 million? At least 10 people should confirm that before we proceed. At least 10 people should confirm that before we proceed. Will you have the 10 million, the 40 million that I'm able to see there? 40 million, 40 million. 40 million, good. So that's what you're required to do. Once you get the total, how do you get the average? You basically tell us the number of observations. So the first observation is this one here. The second observation is this. The third one, the whole of this. 4, 5, 6, 7, 8, 9, 10. So how many observations were you having? You are having 10 observations. And therefore, how do we get the average? It is the total divided by the number of observations. So if you take 40 million divided by 10, what will you have? 40 million divided by 10, what is the average profit? What is the average profit? So the average profit here average profit will be equivalent to total profit divided by number of observations. 40 million divided by 10, which will give us 4 million. So that's what you are required to do. That is what you are required to do in this particular question. That's what you are required to do in this particular question. So is the concept now clear? Is the concept now clear to all of us? That's what that's what you are required to do in this particular question. So under the topic of CVP analysis, there's nothing that will be tested out of this, out of what we did yesterday, and out of what we are going to do on Sunday, which is basically the limiting factor, So that is it. That is what you are required to do. That's what we've been able to do. And of course, I just want you to go and read something about the limiting factor. How do you read something about the limiting factor? If you go to our September, December folder, there's that link for the videos where we covered something about the limiting factor. So what I'm going to do, I'm going to locate that video, then I basically type limiting factor video. So the video below that writing will be helpful to you. Go through it so that when you meet on Sunday, you basically understand what we have to do with the limiting factor. So that when you get to the class now, the limiting factor and throughput will be a 2-hour thing and we are done with this particular area. So that is it. Thanks for your time. Have a blessed night and let's meet on Sunday